morning, everybody, and thank you to the Institute for International Monetary Research for organizing this conference. Steve Hanke and I, who is here on video and will come in later, have put together a study of 89 different economies since the 1960s, studying the rate of growth of money and nominal GDP. Now, that relationship is important, as you will remember from Tim's remarks just now, because if there is a good relationship between money and nominal GDP, that is current spending in the economy, then one would think that an appropriate governance or control of money would give you good nominal GDP outcomes. That, at any rate, is the gist of the quantity theory of money. And I'm going to use that, the study of velocity, or the ratio of nominal GDP to money, or its inverse, which is the amount of money that people want to hold relative to their spending. That's an easier way to think about it. We use that as the basis for our study. Now, the paper is organized as shown in the slide here. And I'm going to go through some parts of this, but not all of it. And I'm also going to change the ordering a little bit so that it's perhaps more appealing to you. First, why study so many different countries? Surely you can just take the example of one country and study it. Well, it turns out that is not the case. Individual countries have special characteristics, and you may have periods of time when things do not conform to the norm. Milton Friedman, who was a famous economist, put it this way. He said, "I believe that you have a more secure basis for a study or for a statistical result if, instead of relying on extremely sophisticated analysis of a small fixed body of data, so that is the data for one country over one period, you rely on cruder analysis of a much broader and wider body of data, which will include widely different circumstances." So if you want to study inflation, you look at it in different countries at different time periods, under different monetary standards, and you will have a much more secure result. What is it that really drives inflation? And as he says, the natural experiments that come up over a wide range provide a source of evidence that is stronger and more reliable than any single very limited body of data. Now, that it's well worth bearing in mind. The other thing to say at the outset is that, like Tim Congdon, we have focused on broad money. That's to say, a definition like M2 or M3. All the money in the economy, all the money created by the banks, who are the primary creators of money, and the money created by the central bank, which is the cash currency held by the public. The central bank also produces bank reserves, but that is not used for day-to-day transactions in purchasing goods and services or assets. It's used for settlement among the banks. The reason, there are several reasons, but I'll only focus on one of them. The main reason why we use broad money is this first one. There are far less distortions if you use broad money. If you use narrow money, that is M1, or current accounts plus cash, or demand deposits, as they call them in the US, plus cash, you will find that the behavior of that series is very much affected by changes in interest rates. If interest rates go up sharply, clearly people's preference will go from non-interest-bearing accounts towards interest-bearing accounts. So you'll get a shift from M1 to M2 or M3. But if you look at broad money, M2 or M3, then that total is not affected by that shift. And you may also get regulatory changes, changes in the rules governing what banks, what interest rate banks can pay, or how often money may be withdrawn from time and savings deposits and so on. So less distortions, it's better to follow broad money. And in fact, in this country, in the UK, the Bank of England produces a very good series, and they call it M4X. One of the creators of that series is here with us today. And that's Ryland Thomas, sitting right here at the front. If you want to ask him about those data, you can do so. In any case, so that's the reason, and there is more to it, but I don't really have time to go into the detail. What I want to focus on, if you take away one image from this talk, I want you to take away this image. So we've got a flow chart here with monetary growth impacting first asset prices, then economic activity, and then finally goods and service prices. And this process is spread out over time. It takes a couple of years for monetary growth to have its full impact on goods and service prices. And this is at the heart of the quantity theory of money business cycle theory. In essence, the business cycle is a monetary cycle. It's driven by changes in the rate growth of money. And many of the faults of the Keynesian story that Tim Congdon was presenting you with just now can be summarized in the idea that on the right-hand side here, we've got economic activity, GDP, and goods and service prices. Most of the textbooks of the post-war period have focused on these last two items only. That is, the income expenditure flow, Y equals C plus I plus G plus X minus M, for those of you who have done the courses in economics. There's then in the textbooks a kind of a separate discussion about inflation, usually driven by theories about the labor market or cost push factors, things like that. But the quantity theory of money is a more integrated theory, and it goes through all these stages. And as Tim said, the behavior of asset prices following changes in monetary growth is extremely important to the impact on economic activity. I always say that you need a sustained and substantial change in monetary growth to have this impact on asset prices and economic activity. We're not looking at a change of over 1 month or 2 months, but if it persists for 4, 5, or 6 months, then it will have the effects on all of these components of the flowchart. So an acceleration in growth of money will lead to higher asset prices, stronger economic activity, and eventually higher goods and service prices. And conversely, for a slower rate of monetary growth. So please keep that image in your mind. That's really crucial. And to illustrate that, I want to show these charts on some major economies. And I want to bring out 2 points in these charts. What you're looking at here is the smooth rate of growth of money. That's the black line in each case. And the smooth rate of growth of nominal GDP. That is spending or economic activity. If I go back, we're basically looking at the rate of growth of money in the first box and the combination of economic activity and goods and service prices in these last two boxes. I'm leaving out asset prices, but we are capturing the effects of money on the last two items in the flowchart. First thing I want you to observe, the right-hand end, is the COVID episode in all these countries: the US, the UK, Eurozone, and Canada. Now, what I've done in these charts is to shift the 6-quarter moving average of the year-on-year rate of change of money. I've shifted it forwards by 6 quarters, 18 months. And so you can see that the surge in nominal GDP pretty much coincided with the money growth rates. In other words, that's saying the surge in spending in nominal GDP came 18 months after the surge in money growth. And not surprisingly, because we had this big explosion of money growth, we had inflation across the board in these countries: US, UK, Eurozone, and Canada. But as Juan just pointed out, and Steve Hanke and I mentioned or discussed at some length in a paper in the Journal of Applied Finance in 2021, some countries did not see the same kind of inflationary outcome. Countries like Japan and Switzerland, which Juan already mentioned, but also China and India, did not engage in such huge monetary expansions. Now, you can see there was a small expansion in Japan, and there was a very small expansion in Switzerland. But in India, there was hardly any change in the rate of growth of money, and in China, there was hardly any change. So when people like Governor Bailey say to parliamentary committees that inflation was entirely imported, there was nothing we can do about it, frankly, that is just nonsense. Excess money was created, and that ended up creating inflation. And you can see that because these countries, which did not create excess money, did not have any significant inflation. Inflation remained very low in Japan, in China, in Switzerland, in India, and there are one or two other countries as well, but these are the primary examples. So here you've got a very clear contrast, an experiment where some countries increased the quantity of money, others did not, and the results are very clear. The second thing I want to say before getting to the results of our paper is that the basic quantity theory is very widely misunderstood and misinterpreted. And I've got here an example by an economist called Peter Stella and some co-authors, Singh and Bhargava. I call them SSB, which is a critique of monetary analysis. It was a paper written for the IMF, working paper 21/6, and called Some Alternative Monetary Facts. And basically what they try to say is the relation between money and spending has evaporated. It used to exist 30, 40 years ago, along the lines that Juan said Jerome Powell had mentioned. And they go about this with statistical tests. But almost all of their tests are based on the wrong data or the wrong concept. Again, I don't have time to go into it in detail, but for example, here on the left, you can see their tests involve M1, which is a narrow money or demand deposits, a part of M1. And then they measure all debits relative to GDP, things like that. So basically what they're doing is confusing two very different concepts. So first of all, they focused on narrow money. They've assumed that money is endogenous, that is to say that it's a result of the central bank's policy of managing interest rates. But the problem with that is, even if money is endogenous, it still matters how much money you produce. If you produce too much money, you will get inflation. I also think that the paper in concern fails to understand why inflation was so low between 2010 and 2020. Basically, and this is widespread misunderstanding, quantitative easing, which was introduced in 2009, 2010, was a way whereby the central bank created money. It purchased securities primarily from non-banks and wrote checks to the sellers. That directly increased the amount of deposits in the system and pushed up the money supply. You will never hear that explanation from central banks, but that's essentially what happened. And because that didn't create inflation, I think that led to a kind of complacency that if you create money through the central bank, it doesn't create inflation. And that turned around to bite the central banks in the COVID episode, because they basically used the same mechanism, the purchase of securities, and then they were surprised by the surge in inflation. A further failure is the failure to distinguish between two types of QE. This is a bit technical, but basically, if a central bank buys securities from non-banks, that creates money, because the central bank pays a check to, nowadays it's all electronic, but it pays a check to the seller. But if a central bank buys securities from a bank, as they did in Europe or in the ECB or at the Bank of Japan, that does not create money. It's an asset swap between banks and the central bank only. It doesn't create any money in the hands of the public. And then the two concepts which I mentioned earlier, to go back here, this debits to GDP notion. What's the mistake there is the distinction between transactions per unit of time, which is what this is about, and dollars of income generated per unit of money. That is, the amount of money that people want to hold per unit of income. Those are two very different things, and that is widely misunderstood in modern economics. What we are interested in is the demand of the public at large and firms to hold money, how much they want to hold. Historically, that amount of money has gradually increased year by year. Now, because we measure it as velocity, that's the inverse of it. That is nominal GDP divided by money. Historically, that in most countries has been downward sloping, as I'll show you in a moment. And in the United States, that was the case up until 1946. And this is the data for the US. You can see on average it declined by about 1.5% per annum, or if you like, money holdings increased by 1.5% per annum, irrespective of income, between the end of the Civil War, 1869 or thereabouts, and the end of the Second World War. But then there was a series of changes. After the Second World War, velocity rose strongly. It then had a period of stability in the US, then rose very sharply, then fell very sharply during the COVID episode. Now, a lot of economists have looked at this rather superficially and said, oh, well, velocity is unstable, we can't rely on it. In other words, the relation between money and spending or money and inflation is unreliable, and therefore, we can't rely on it, therefore we should ignore it. And what our paper is designed to do is to show you that that is false. Now, in the US case, the US is actually an anomaly. And yet every economist, almost all economists, have based their knowledge of velocity and the demand for money holdings on the US case history. So the US, although you will be taught about it, remember it's an anomaly. What was going on during this period? Well, in the immediate post-war period, there was inflation. Then there was a series of deregulations through periods 1 and 2 here. This is through the 60s, 70s, and into the early 90s. And then finally, from the late 1990s onwards, the US has reverted to trend. That is, remember the pre-war trend declining at 1.5%. Once again, it's declining at about 1.5% per annum. So the US is a major anomaly because, as we'll show you, if you look at velocity across, first of all, the 24 developed economies that we've studied, it's actually 25, but we cut one out, I'll explain, and then 65 emerging economies. You can see that the trend, the dominant trend, is downwards. This data is from 1960. Of course, there isn't data for some of the countries, but for these developed 24 economies, it's clearly downward sloping. We cut out Luxembourg because it's way down here, and that's because Luxembourg is a financial center. It has a lot of deposits from other parts of Europe, and so although the ratio is downward sloping, it's way out of line. And so basically Luxembourg has a much larger quantity of money there than you would otherwise expect, but that's because of its special position. Similarly for M3, the dominant trend is downwards, again for these 24 developed economies. And if you take the maximum, minimum, and median of those charts or that data for M3, you get a picture like this. Again, downward sloping. And similarly for emerging economies. Here's our 64 emerging economies. Again, a clearly downward sloping pattern for M2 and for M3. And if we again do the sort of maximum, minimum, and median, these are the numbers you get. Why should velocity be downward sloping? That is, why should, turning the fraction the other way around, why should the amount of money that people want to hold relative to their income gradually increase over time? My thinking, and I think generally those who study this would agree with me, is that money is a financial asset. And as we get richer, we tend to hold more financial assets. Money is simply one of those financial assets. So as you get richer, as people get richer, they tend to hold more money. And these trends illustrate that tendency. Despite the fact this has been going on for 60 years or more in the post-war period, it shows no sign of ending. So what does that mean for us? Well, it means, if we look at the data again that we've compiled, the median trends for the developed economies were for an annual decline of about 1.7%, 1.8%, or a slightly higher number for emerging economies, 2.9%, 3.0%, something of that order. And I have that also summarized here on a compound annual rate of change basis for M2 and M3 in the developed economies, M2 and M3 in the emerging economies. Now, what does that mean in practical terms? I don't know if you remember, and I'm afraid I've failed to bring this to your attention. In those charts I showed you of the four economies, US, UK, Eurozone, and Canada, of money growth and inflation. There was a gap between the black line, which is money growth, and the red line, which is income growth, nominal income, nominal GDP. What that means is that is the accumulation of money balances as people are getting richer. And that gap is equal to those figures that I've just given you. That is the annual rates of change of velocity. So if you're designing a monetary policy based on the quantitative theory of money, what you have to do is try to organize a rate of growth of money which does three things. It finances the real rate of growth, number one. Number two, it finances this increase in desire for money holdings each year. That is, it accommodates the decline in velocity. And thirdly, it meets the inflation target. So if we take the example of the US or the UK, with a growth rate of the economy of, let's say, 1.5%, and an inflation target of 2%, that's 3.5%. And then we add these figures for the rate of change of velocity, then you have a roughly 5% desired rate of money growth for stability. Well, there are various conclusions from this. I've divided them into positive, that is the results I've given you, but also the normative, that is how you would design a monetary policy based on those findings. With that, I will stop my remarks and see if Steve Hanke would like to comment. Steve, over to you.
Okay, John, thank you. Great to be with you all virtually. In any case, last night I was thinking about what I would comment or make remarks about after John's lecture, and I thought, well, that's going to be tough because he covers things pretty clearly, which he just did. But I did have one major thought, actually, and we'll have to, when we revise our paper, we can include this thought. And that is something that's research that's consistent with what John has found and I have found and what John's just presented, and that is that the velocity is what we call trend stable. That is, if the velocity deviates from the trend, it returns to it in subsequent periods. That's a major finding, because if that's not true, if in fact it's different stable, in other words, if changes in velocity from one period to the next were not related, then you could pretty much rubbish the quantity theory of money. The operational aspect that John indicated, where you'd have 5-6% for the United States or the UK, is a stable money growth consistent with hitting the inflation target of 2%. Well, that just wouldn't hold water if you, in fact, did not have trend stable velocity. And of course, now my thought, other research that's consistent with what John and I have just presented is a piece that I wrote in World Economics in the July-September 2023 issue, and that dealt with what Tim Congdon has written quite extensively about in his last two books, The Quantity Theory of Money and New Restatement, and Money and Inflation at the Time of COVID, and that's the proportionality postulate. And the proportionality postulate was articulated very clearly by Milton Friedman, and I'm quoting Friedman. He said, "I know of no exception to the proposition that there has to be a one-to-one relationship between substantial changes, substantial rises in prices, and substantial rises in the stock of money. That one-to-one relationship is the proportionality proposition." Now, the question is, well, how how do you look at this? How do you test it? And what I did, again, using the same methodology that Friedman laid out and John articulated with our broad sample, looking at all these countries and looking at their velocity. I looked at 147 countries and correlated the changes in the stock of money with changes in inflation. And what I ended up with was a confirmation of what Friedman said. Out of the 147 countries, the correlation coefficient was 0.94. And if you knock out the 8 outlier countries and come down to 139, the correlation coefficient is 0.97. The 31 OECD countries, 0.82. 28 Latin American countries, it was 0.96. 17 former communist countries plus China, 0.94. The 4 BRICS countries, 0.99. So the proportionality postulate holds, and it would not hold, John, if the velocities weren't trend stable, which we found using another approach to the quantity theory of money, which you've just presented today. Our research shows that velocity is trend stable. And if it's trend stable, that suggests that the proportionality postulate would have to hold, as Friedman asserted it did, and I've shown in these 147 countries that it did. So we have 2 pieces of research that basically say the same thing. The quantity theory of money is alive and well. That's it, John.
Great. Thank you very much, Steve. Thank you, everybody.